Hi, welcome to Archiversity online classes. In my previous lecture, I explained you how to calculate summary statistics of select stocks using their close prices. And I mentioned that when you have to compare stocks, then it is better to use a relative performance measure rather than a close price. The relative measure is percentage return. And in initial classes, I explained you how to calculate the percentage return on a stock. That is, the percentage return is current price minus previous price upon previous price times 100. So that you will get a return in a percentage value. So in this lecture, using the relative values, that is the percentage returns, I am going to compare the performance of 4 IT stocks, that is information technology stocks listed in BSE Sensex. Here are the daily returns measured in percentage terms of HCL, Infosys, Tata Consulting Services and Tech Mahindra for the period 3rd April 2022, 30th September 2020. And instead of calculating the descriptive statistics using a data analysis tool pack, for simplicity, we calculate 4 important descriptives, that is a minimum return, maximum return, average return and a standard deviation of these stocks using a Excel built-in functions. So to get our minimum return, the Excel built-in function is min. So type equal to min, then open a bracket, then select your data. So your data is in column B, that is for HCL stock daily returns are in column B. So we'll take a B to B. Then close the bracket, press enter key. Now drag this to the right side to get a minimum return for the remaining 3 stocks. Just expand this one. So you have a minimum return for these stocks. Then maximum return. To get a maximum return in Excel, we have a function called as a max, max. So we'll type that one equal to max, max. Then open a bracket, then your data is in column B, so B to B, close the bracket, press enter key. Now drag this onto the right side. Now you have a maximum return mentioned here, right? Then what is the average return? So average return, Excel function is average, so equal to AVE RAG average. Select this one, open a bracket, then B to B, press enter key. Average is 0.58%. Then drag this onto the right so that you will get a average return for all the stocks. Then the standard deviation equals to STDEV.S. Because this is a sample data, I am using a stdv.s, and this option is available in Excel 2010 onwards. Earlier versions have stdev. Once you select stdev, then select the range, that is a B to B. While selecting the range as a B to B, you should be confident that there is no other data in a particular column. So after that, press enter key. Then you have a standard deviation of 2.54. Drag this onto your right side to get the values for remaining stocks. And now if you observe here, during the period, HCL stock yielded a maximum return of 11.5%, whereas Tech Mahindra gave you a minimum return of 5.53%. This is on a positive side I am saying. And when it comes to the losses, then Tech Mahindra has incurred a major loss of a minus 7.99, whereas HCL has a minus 5.24. And if you observe the standard deviations, the standard deviation of HCL stock is high, that is 2.54%. On the other hand, Tech Mahindra has a low standard deviation, that is a 2.20. Now the high standard deviation, high return indicates that during the COVID time period, that is the past 6 months, HCL stock witnessed high volatility in its prices. And if you see the range here, the range is also high in case of a HCL Technologies. And coming to the average return, HCL has a high average return, that is a 0.58%, whereas TCS has a low average return, that is 0.32. So even though all the four stocks belong to the same industry, that is information technology industry, their average returns are not same. One has an average return of 0.58%, other have an average return of a 0.32%. So that means during the 6 months period, these stocks didn't even yield you 1% return. On the other side, the standard deviations are also not uniform. They are, in case of HCL, the standard deviation is high, whereas in case of TCS, the standard deviation is low. So this gives you a clue that blindly we should not go for an industry. In the sense, within the same industry, each individual stock have its own performance. Now, if you see that the average return of a HCL, Infosys, TCS and Tech Mahindra, they are not same, they are different. Can we prove that whether the average return of HCL and Infosys, that is the two stocks, are the same or they are different? The average return of all these four stocks are uniform or they are different. To know that, you need to perform two additional tests. That is, if you are choosing only two companies, that is the HCL and Infosys, and you wish to know whether the average return of HCL and Infosys are same or they are different, then you have to use independent sample t-test. And if you want to see that whether the average returns of all the four stocks are the same or they're different, then you have to use analysis of a variance. In my next two lectures, I'm going to explain in one lecture the independent sample t-test, and in the second lecture, I'm going to explain you the analysis of a variance. Thank you for watching the lecture. Thank you.